Stop what you're doing for a second because the next move in precious metals won't feel like a normal rally. It will feel like a door slamming, the kind that makes people stare at their screens and ask, did that really just happen? And right now, as I'm recording this, it's Friday, January 23rd, 2026, and the exact time is 10 a.m. Comment the time you're watching this because I want to see where in the world this message is landing. Now, before we go any deeper, quick favor. If you're getting value from this breakdown, hit subscribe right now. We're pushing hard to grow this channel, and your click actually matters more than you think. All right, let's get into exactly what's happening beneath the surface. Why silver's recent surge looks less like a top and more like a launch sequence, and what comes next for anyone watching this unfold. Here's what's wild. We're not just talking about a shiny metal rally. We're talking about a market that's behaving like it's getting repriced, as if the old labels are being peeled off and replaced in real time. Gold is hovering around the edge of $5,000 per ounce, and silver is flirting with the psychological wall at $103. That alone is enough to wake people up, but that's not the real story. The real story is what's happening underneath the surface, inside the plumbing of the financial system, where the pressure builds quietly. Then suddenly the pipe bursts, and everybody pretends they didn't smell the gas 5 minutes earlier. Now, watch this carefully. Today, I'm going to walk you through 3 things. First, why silver's recent surge looks less like a top and more like a launch sequence. Second, why the bond market is the sleeping monster most people refuse to look at. And third, the uncomfortable truth about what happens when governments try to fix that monster with printed money, and why metals usually react in a way that shocks even the people who claim they're prepared. Okay, let's set the stage properly. In every bull run, there's a moment where price stops acting like price. It stops climbing politely. It stops waiting for permission. It starts moving as if it's trying to get away from something. If you've watched markets long enough, you know that moment has a signature. The pullbacks get shorter, the pauses get tighter, the dips that used to take weeks now take days, and the dips that used to take days start happening in hours. People call it momentum. I call it time compression. And when time compresses, one headline can do the damage of a whole quarter. Silver is showing that signature right now. But I need you to understand why that matters. Because the average investor gets tricked at exactly this point. They look at a chart and say, it already doubled, it already ran, it's too late. Now here's the twist. That sentence has destroyed more portfolios than bad companies ever did. Because in these kinds of moves, the early phase feels exciting and the middle phase feels boring. And then the final phase feels illegal. The final phase is where the candles get tall, where the headlines get loud, and where people who mock the trade suddenly start explaining it to their friends like they discovered it. The big clue today is not just the price of silver, it's silver's relationship to gold. Think of gold as the grandparent in the room. Quiet, respected, heavy, slow-moving, the asset people whisper about when they're nervous. Silver is the younger sibling, more volatile, more emotional, more tied to factories and electricity and real-world demand. When silver starts gaining ground against gold, it's not just a metal rally, it's the market's risk temperature changing. And this week, that relationship has moved in a way you can't ignore. With gold near $4,150 and silver near 105s, the gold to silver ratio is sitting around 50.1. Now watch what this means. That's not some random number. It's a psychological boundary because for long stretches of modern history, that ratio has lived higher than that. When it drops fast, it's telling you silver is moving from also ran to main character. Here's the twist. Silver doesn't have to become rare overnight for this to happen. It just has to be treated as scarce. And scarcity is not only about geology, scarcity is also about logistics, refining capacity, fabrication, inventories, and whether the market can get real metal delivered when it actually wants it. Paper contracts can pretend everything is fine, right up until the day they can't. And that's the moment that changes everything, because when the paper market and the physical market disconnect, the price adjustment is violent, not gradual, violent. Now let's talk about the pattern that leads up to a true breakout, because this is where most people get shaken out. In a typical climb, you get a push upward, then a messy sideways period where the chart looks like it fell asleep. Everyone gets bored. The loud voices declare the rally is over, then the market springs again. Rinse, repeat. It's like the market is building stair steps. Each step is a new base. Silver has done that for years, and it did it in a way that trained people to doubt it. Every time it poked its head up, it got slapped down. Every time it got exciting, it got quiet. That conditioning matters because the market likes to punish the largest number of people. If most people expect the slapdown, the next move is often a surprise in the opposite direction. And when that surprise comes, it comes fast. Now add a new ingredient. industrial demand that isn't a rumor anymore. Let me give you a data point that almost nobody on social media talks about because it's not sexy, but it's powerful. In 2024, total global silver demand was around 1.16 billion ounces, and industrial demand hit another record year driven by electronics and electrical applications. The solar sector alone consumed roughly about 200 million ounces of silver in 2024, around a fifth of total demand, depending on how you slice it. And in recent years, solar has become a monster buyer compared to a decade ago. That matters because a lot of people still talk about silver like it's just coins and bars. They picture a vault. They don't picture a solar farm. They don't picture wiring, circuitry, medical applications, sensors, and the endless small places where silver is used and then dispersed. And once it's dispersed, it's gone. It's not coming back to the market. It's embedded in infrastructure that will last decades. Now, I'm going to say something that might make some silver bulls angry, but it's necessary if you want to survive the next phase. Industrial demand is strong, yes, but industrial demand isn't the only driver. In a true squeeze, investment demand can overwhelm the market far faster than industry can. That's why silver can go vertical. But it's also why silver can fall hard in the middle of a vertical move. And that leads to the first cliffhanger you need to prepare for. Even if silver is headed much higher, there can be a brutal shakeout that happens right in the middle, designed to make confident people panic. Hold that thought because we're coming back to that exact mid-move trap in a few minutes, and it might be the most important thing you hear today. Before that, let's zoom out to the macro backdrop that's turning this from a normal bull run into something more dangerous and possibly more profitable for those who stay disciplined. Now, here's what you need to understand. Look at the bond market. Most people treat bonds like boring background noise. They think of bonds as the thing your uncle holds in retirement. They think of bond yields like a technical detail that only economists care about. That mindset is a luxury, and luxuries get taken away in crisis. Here's where we are right now. Long-term government yields in major economies are elevated and jumpy. In the United States, the 30-year yield has been hanging around the upper 4% range this week. In the United Kingdom, long-dated gilt yields have been in the low 5% area. In Japan, officials are openly warning about rapid moves in long-term rates, and markets are obsessing over what the central bank will do next. Why should you care? Because the bond market is the spine of the modern system. Stocks get the headlines, but bonds carry the weight. Governments finance themselves through bonds. Banks treat bonds as safe collateral. Pension funds are built around bonds. When bonds wobble, the entire tower feels it. And here's the nightmare scenario nobody wants to say out loud. A true loss of confidence in government debt doesn't look like a normal crash. It looks like a credibility event. That's why some people call it nuclear. Not because it literally explodes, but because it changes the rules of the room. Once credibility cracks, it's hard to glue back together. Now, I want you to think about what governments do when credibility cracks. They don't shrug and accept austerity. They don't politely default. They reach for the lever that has saved them before. Liquidity. And liquidity is a nice word for money creation. When central banks lean into money creation to calm a debt market, they can stabilize prices temporarily, but they also send a message that the currency unit is being diluted to protect the bondholder. And that message travels fast. That's why metals react like they do. Metals are not voting for a party. Metals are not cheering for a politician. Metals are reacting to the math. And the math is simple. When currency gets diluted, hard assets get repriced upward. That's not a theory. That's a pattern that repeats across centuries. Now let me bring in another fresh number that adds weight to this. In fiscal year 2025, the US government ran a deficit around $1.8 trillion. Interest costs have become a monster line item. There were reports of interest spending topping $1 trillion over that fiscal year. That's not a typo. When interest becomes that large, it becomes politically radioactive. And it also becomes financially destabilizing because you can't cut interest without cutting rates. And you can't cut rates without risking inflation expectations. And when you put that loop next to a bond market that's already nervous, you get the conditions for a sudden pivot. Not a gradual policy shift, a sudden one. And sudden pivots are when markets gap. They don't drift, they gap. And gaps don't ask your permission. If you're not positioned before the gap, you're paying the premium after the gap. Now, here's where I'm going to challenge one major narrative floating around right now. A lot of people are saying this is all about manipulation breaking or they finally lost control. It's a dramatic story. It's also incomplete. Yes, markets can be influenced. Yes, big players can lean on price. But the bigger driver isn't a single villain. The bigger driver is structural. Supply chains, deficits, industrial consumption. and the amount of currency created to fund governments. In other words, even if you removed every alleged manipulator from the room, you'd still have a setup where tangible assets get repriced upward when paper promises get questioned. That's the uncomfortable truth. And it's why this move doesn't depend on one headline, it depends on the system's balance. Now let's talk about the part that makes people's eyes widen. Targets. You've heard wild numbers, $200, $300, $500. And I'm not here to laugh at them. In extreme conditions, silver can overshoot. It has a history of violent bursts, but I'm also not going to hypnotize you with a number and forget the journey, because the journey is where people fail. So instead of worshiping targets, let's talk about drivers. If gold continues to push higher in a risk-off environment, and if the gold to silver ratio compresses further, then silver can mathematically reach levels that feel surreal. If gold ran towards $7 or $8,000 in a multi-year credibility crisis, and silver reclaimed a more aggressive historical relationship to gold, then yes, silver could land in the multiple hundreds. But here's the skeptical alternative you must respect. Silver is also an industrial metal. If we hit a deep recession that crushes manufacturing, industrial demand can soften. And if solar manufacturers reduce silver content per panel faster than demand grows, that can dampen the tightness at the margin. So the question is not, can it hit $500? The real question is, what sequence of events gets us there and what pain happens in between? Because pain is guaranteed. And if you're not prepared for the pain, you won't survive to capture the gain. Now let's return to that mid-move trap I warned you about. In past explosive runs, silver has often staged a nasty reversal at the halfway point. Not because the bull market ended, but because leverage players got flushed. The market shakes the tree to see who falls. Then it climbs again. So if you're watching silver rip higher and you're thinking, I'll just wait for the pullback, be careful. Sometimes the pullback is only a few hours. Sometimes it's a sudden air pocket that drops 12% and then recovers before you even finish your coffee. And sometimes the pullback comes after an even more insane move that leaves you frozen. This is why I'm insisting on discipline, not hype. Discipline means having a plan before the candles get tall. Discipline means knowing your rules before emotion takes over. Discipline means deciding now what you'll do if silver drops 15% in one session. Now let me make this practical. If you already hold metal, the battle is psychological. The market will try to bully you into selling too early. The headlines will scream top. The comment sections will fill with people calling for collapse. And then on the day you sell, the market will often rip in your face. If you don't hold metal, the battle is also psychological because buying after a big move feels painful. It feels like you missed it. But the truth is, in a structural repricing, the early move is a warning, not the end. The real move often comes after everyone thinks they missed it. So what should you watch? Watch the bond market. Watch currency volatility. Watch the pace of central bank reserve behavior. And watch the gold to silver ratio like it's a heartbeat monitor. For example, central banks were still accumulating large amounts of gold in 2025, with quarterly purchases staying elevated in the hundreds of tons range in at least one quarter. That's not retail panic. That's institutional hedging. And those institutions don't hedge for fun. They hedge because they see instability coming. And here's the part that makes this even more explosive. The public is still late. Most people are not positioned. Most people are not even paying attention. They're busy arguing about the latest headline while the core mechanics shift underneath them. When the public finally wakes up, it won't be a gentle transition. It'll be a stampede. And stampedes don't wait for you to put your shoes on. They run you over if you're not already moving. Now let me connect two dots most people never connect. Bond stress and metal upside are not separate stories. They're the same story told in two different languages. In bond language, the story is yields rise, prices fall, auctions get shaky, volatility spikes, and policymakers start talking about operations and stability. In metal language, the story is confidence fades, currency units get questioned, and the store of value assets get bid like lifeboats. You can see it in the behavior of the dollar, too. When the dollar weakens even modestly, it adds fuel to metals. But the deeper issue is not a single week's currency move. The deeper issue is trust. And trust is not built with press conferences. Trust is built with restraint. So what happens when restraint disappears? That's when the market starts repricing everything at once. Not just metals, real assets, energy, land, commodities, the stuff that can't be printed. And when everything reprices at once, the volatility is breathtaking. And speaking of commodities, let's talk about another piece of this puzzle that's quietly setting up. Energy. A lot of analysts love to predict oil down to some dramatic number. They love to say demand collapses. They love to say oversupply. And sometimes they're right for a while. But there's a reason energy matters in this narrative. Energy is the tax on everything. When energy rises, it raises the cost of production, transport, food, materials, and ultimately living. That's when people feel inflation in their bones, not in a spreadsheet. If oil catches a bid while metals are already running, it becomes a second wave of psychological pressure on the public. People don't panic because they saw a chart. They panic when they see the gas pump spinning too fast. And panic is when the real repricing happens. Now, I'm not here to promise you a specific oil price. I'm telling you to watch the possibility of an upside surprise. Because in a world where money is being created to keep debt markets calm, commodities tend to get repriced upward as the currency unit loses real purchasing power. And that brings us to another trap, the distraction trap. In every cycle, the public gets distracted by the shiny debate of the month. Tariffs, elections, trade disputes, a crisis here, a headline there. Those things matter, but they're often surface waves. The deeper current is the same: debt and currency. If the debt pile keeps growing and servicing costs keep rising, policymakers will choose the path of least immediate pain, which usually means inflationary policy. They won't call it inflation. They'll call it support or stability or growth, but the outcome is the same. Your currency buys less over time. That's why metals can move even when the public thinks nothing is happening. Something is happening. It's happening in the arithmetic of the system. It's happening in the bond auctions. It's happening in the central bank balance sheets. It's happening where most people don't look. Now, I want to ask you a question, and I want you to answer it in the comments. If silver breaks above $150 and then pulls back sharply, would you see that as a warning or as an opportunity? Tell me your honest answer, because your mindset matters more than your prediction. And here's another one. Do you think the bond market is the real story? Or do you think the stock market is still the main driver? Comment that too, because I read these and it helps me shape what I cover next. Now, we need to address something that's going to be controversial, but again, it's necessary. Alternatives. In the last few years, a lot of people treated digital assets like the new safe haven. Some made money, some got wrecked, and the marketing around it got loud. But in a credibility crisis, the crowd tends to return to what has survived credibility crises before. Not because it's trendy, but because it's tested. That doesn't mean every alternative asset goes to zero. It means the hierarchy shifts. In panic, liquidity and history matter. That's why gold tends to lead. That's why silver can then sprint. And that's why a sudden shift in sentiment can turn a calm market into a feeding frenzy. And when the frenzy begins, the assets with no counterparty risk are the ones that get bid the hardest. Now, here's the most important part. This can happen faster than you think. People assume markets move in years. Sometimes they do. But when confidence breaks, markets move in days. The timeline collapses. That's when people beg for entry and get none. And that's why I'm telling you to prepare for speed. Not next year, not next quarter, now. Because when the door slams, it slams fast. And you don't get a second chance to be on the right side of it. Now, I promised you fresh information that isn't just recycling what you've already heard. So let me add concrete context you can use today. Silver has been running structural deficits in recent years, meaning demand has been outpacing supply. Estimates for 2025 deficits have been discussed in the neighborhood of 100 million ounces. Whether the exact figure ends up higher or lower, the core point is this. Deficits don't have to be massive to matter. They only have to exist consistently because inventories are not infinite, and the supply side isn't a simple switch. A huge portion of silver production comes as a byproduct of mining other metals. That means you don't just mine more silver because silver got expensive. You often mine more copper, lead, zinc, and then you get more silver along the way. So the response time to higher prices can be slow, especially if other metal markets are not expanding production at the same pace. So if you're waiting for supply to rush in, understand the supply mechanism. It's not a faucet you turn, it's a chain you have to build. Now layer that onto industrial demand tied to electrification and the energy transition. Even with thrifting, reducing silver loadings per solar cell, installations can grow fast enough that total consumption still rises. That's why you can see a world where manufacturers try to use less silver per unit, but still end up consuming a massive total volume because the number of units explodes. That's the tug of war. And in a squeeze, tug of war turns into a snap. Now let's bring it back to the psychological timeline, because this is where high retention comes from. Knowing what happens next. Here's what I think is most likely in the near term, based on how these markets behave during credibility shocks. Phase 1. Metals keep grinding higher with pullbacks that feel annoying but manageable. The public calls it a bubble. The professionals quietly accumulate or hedge. Phase 2. A catalyst in the debt market, currency market, or geopolitical arena accelerates the move. Silver begins to outperform dramatically. The ratio compresses further. People who ignored metals suddenly start looking at them. Phase 3, the midpoint stumble. A violent pullback that feels like the end. Headlines scream collapse. Weak hands dump. Strong hands absorb. Phase 4, the blow-off advance. This is where prices do things that feel unrealistic. This is where the late crowd arrives. This is where you see days that look like a whole month condensed into a candle. And then eventually phase 5, the aftermath. The part nobody wants to talk about. The part where policy responses and market structure determine whether the new price reality holds or whether it partially retraces. Notice what I didn't do. I didn't promise you a single straight line because that's not how markets work. The straight line story is how people get trapped. The real story is messy, violent, and psychological. And if you can survive the mess, you can capture the move. Now let's get tactical again, because we're entering the part where your decisions matter. If silver holds above $100, that's a headline event. But the bigger signal will be what it does after the headline. Does it snap back quickly after dips? Do buyers show up immediately? Does the ratio keep compressing? If you see dips being bought in hours instead of weeks, that's acceleration. That's the market telling you liquidity is pouring in and sellers are getting exhausted. At the same time, watch the bond market for signs of strain beyond normal noise. Rising yields alone are not the whole story. The story is volatility, failed rallies, and policymakers sounding nervous. When you hear language about providing liquidity or ensuring orderly market function, that's often a sign the system is wobbling. And when the system wobbles, people reach for assets with no counterparty risk. Gold, silver, real assets. The things that can't be diluted by a vote or a press release. Now, one more skeptical angle because I don't want you to be blindsided by the bear case. If policymakers manage to stabilize long-term yields without reigniting inflation expectations, if they pull off a rare balancing act, metals could consolidate for longer than bulls expect. Price could turn sideways. It could frustrate you. It could make you doubt. And that's exactly why I keep talking about time compression and psychology, because sideways markets are where conviction dies. And conviction dying is the fuel for the next leg higher. So don't confuse boredom with failure. In fact, boredom is often the incubator for the next surge. The market loves to bore you to death right before it makes you rich. That's the pattern. That's the trap. And if you understand it, you won't fall for it. Now let's talk about what a real reset looks like in plain language. A reset doesn't need an official announcement. A reset can happen in your living costs, your purchasing power, and the way assets are priced. If the currency unit is diluted enough over time, assets get repriced to reflect that. The public calls it a boom. In reality, it's a measurement problem. When your measuring stick shrinks, everything measured looks bigger. That's why an ounce of gold's buying power can remain stubbornly strong across decades while the paper notes get thinner in real terms. So when you see gold near $5,000 and silver above $100, don't just think expensive. Ask expensive in what? Expensive compared to what unit? If that unit is being diluted, the metal isn't necessarily the thing changing the most. The measuring stick is. And when the measuring stick changes, everything else appears to move. But what's really moving is the currency. The metal is just holding its ground. Now, the most viral part of this entire conversation is what happens if we get a genuine bond panic. If confidence in long-term government debt breaks, policymakers will almost certainly respond with support. That support may be rate cuts, direct buying, new facilities, or something dressed up with a fancy acronym. But the effect is usually the same. More currency units chasing the same real-world stuff. And that's when metals can surge in a way that feels like a trap door opened beneath the market. Now, I want you to imagine the sequence. Stocks wobble, bonds wobble, currency swings. People look for safety. The first wave hits gold. Then silver, being smaller and thinner, can move like a spring. And then suddenly, silver isn't moving 5% in a week. It's moving 5% in a day. Then it's moving 10% in a day. Then the exchange changes margin requirements, and people can't hold their positions. And the market whipsaws violently. That's not fear-mongering. That's how thin markets behave when money floods in. And silver is a thin market. It's a small market compared to stocks or bonds. And when a small market gets flooded with capital, the price action is explosive. So how do you survive it? You survive it by deciding your plan before the candles get tall. If your plan is to wing it, you will freeze at the worst moment. You will sell low, you will chase high. You will become a statistic. Instead, decide your rules. Decide what you own and why. Decide how you'll react to a sudden 15% drop that happens in one session. Decide whether you're holding for a multi-year thesis or trading for a short-term pop. Most people don't lose because their thesis was wrong. They lose because they had no process. And process is what separates winners from casualties. Process is boring. Process is disciplined. Process is what keeps you in the game when emotion tries to kick you out. Now, let's connect this to what you should watch over the next few weeks. Watch upcoming policy meetings, watch language shifts, watch whether officials talk more about inflation or more about stability. When stability becomes the priority, liquidity tends to follow. Watch whether the dollar continues to feel heavy. Watch whether other currencies experience stress. Watch whether emerging markets accelerate reserve diversification behavior. Those are signals of a broader shift. And watch the commodity complex beyond metals. If you start seeing base metals and energy firming at the same time as precious metals, it often signals the currency unit is being repriced across the board, not just in metals, everywhere. Now, I also need to address the biggest emotional question people keep asking. Should I switch from silver into gold? Should I take profits? Should I rotate? Here's my answer, and it's simple, but not easy. Don't let FOMO make that decision for you. Gold is typically the steadier vehicle. Silver is the faster one. Rotating can make sense in certain conditions, but it can also become a trap where you sell the thing that's about to sprint and buy the thing that's about to rest. Instead of making emotional swaps, consider the ratio. If silver has been undervalued relative to gold for years and is now waking up, it may have a period where it outperforms. That doesn't mean gold fails. It means silver can catch up. But remember, silver's catch-up is rarely smooth. It's usually violent. So if you're going to hold silver, you need the stomach for it. If you don't have that stomach, don't pretend. There's no shame in choosing the asset that matches your temperament. Temperament is an underrated edge. And knowing yourself is more valuable than knowing the market. Because the market doesn't care about your feelings. But your feelings will determine whether you survive the volatility or get shaken out at the worst moment. Now, we're nearing the end, and I want to tie this up with the biggest cliffhanger of all. If the bond market stress escalates, the response could trigger a chain reaction that pushes metals into a new regime. And once a new regime is established, the old price anchors stop working. People who kept saying, "it can't," get forced to update their worldview. But if the stress pauses, if there's a temporary calm, metals could consolidate, and the public could fall asleep again. So the question is, are we at the start of the chain reaction, or just at the first tremor? That's what the next few weeks will tell us. And that's why you need to stay aware. Not panicked, not frozen, aware. Now, one last thing before I let you go. If you enjoyed this breakdown, do me a favor. Drop a comment with your timestamp. Answer the questions I asked, and share this with someone who keeps saying metals are dead. Not because you want to win an argument, but because you might help someone protect their future. And remember, in a world where paper promises wobble, the assets with no counterparty risk don't need permission to move. If this breakdown gave you a new perspective, hit subscribe right now so you don't miss what happens next. I'll see you in the next one. And just a reminder, this entire video is for educational purposes only. I'm not your financial advisor. I don't know your personal situation, and nothing here should be taken as a direct instruction to buy or sell anything. Use this information to learn, then make your own decisions or speak with a qualified professional.